All right. Sarah, Hazim, I think we are all set at this point.
Okay, well, let's begin our meeting and begin with a roll call.
First, just a reminder, we are live streaming and recording this meeting. Both of those have already started. Jerry Abrahams?
Here.
Phil DeFranzo?
Here.
Timothy Hodges, I believe, is not in this meeting today. My apologies. Catherine McKinnon?
Here.
Commissioner Perez?
Here.
Franklin Perry?
Here.
Chelsea Ross? Sarah Sanders?
Here.
We do have a quorum in attendance for the meeting.
Okay, first I'd like to recognize Tim Hodges for his service to this committee. He's decided to go off to a competing committee, the Mortgage Committee. But he's been on our committee a long time. We really appreciate all his input and insights, and he'll continue to join us from time to time in our committee. So we have a pretty short agenda today, an action item on financial advisors, and then our traditional reports. So let's get right to our resolution on financial advisors. Hazim?
Good morning. This morning, I'll be presenting a resolution to the full board to select financial advisors for CHFA.
Oh my gosh. Sorry.
Lorraine, for financial programs. As required by our statute and procedures, we are to conduct and publish an RFP once every 3 years for financial advisors. The appointment will be effective for 3 years or for the calendar year 2026, 2027, and 2028. The last evaluation was done in 2022. In summary, CHFA, we received 5 proposals, and each proposal was evaluated using a set of criteria, including weighing the firm's experience, technical expertise, ideas, reputation, and financial stability. Accordingly, we are recommending 2 firms, Kane Mitter and Associates and CFX, to act as CHFA financial advisors and perform financial functions as determined by CHFA. I'll be happy to answer any question the committee may have regarding the recommendation.
I have a question. I can't figure out where my hand is today. I figure it out. There you go. My hand is up.
Sure.
Who's our current advisors?
If you look at so right now we have on the slide the one with the asterisk. So we have 3 functions that when we...
Okay, I got it, because I got the package, but I missed the asterisk.
Yeah.
So Kane is one of our advisors, but CFX is not. So who was the
CFX,
other one?
For the swap, the incumbent is Mohanty Gurjulo.
Okay, I'm confused about how you do this, correct? So Service is one.
Correct.
Kane is the current one.
Yes.
And you recommended them again. And
Correct.
CFX is not. They're new. They may not be
Correct.
new.
For that particular service, correct.
Okay. And then why do we have so many? Why do we have different tranches, for lack of a better word? Have you thought about hiring one company to do the whole thing? Or there's no such thing. There's no one company that can do the whole thing.
No. If you look at the services, so what we want for services, one is a firm that will be responsible for providing pricing advice and then structuring for our bond deals. For services number 2 is relating to any swap or derivatives that CHFA may enter into if it issues variable rate debt. And number 3 is more due to the post-issuance cash flow management rating agency analysis. So that's part of the reason why we broke it down into 3 services and then uses 1 RFP. In the past, Commissioner, you may have remembered that we may have issued multiple RFPs for each one. So we just issued 1 RFP to deal with all 3 services.
Okay, I understand that.
Yep.
But my question is not that. Since we issue 1 RFP, and since we have information about other companies, why, I want to understand the logic why are we using Kane for services 1,
Correct.
services 2, services 3, and why why is it not only Kane, for instance? And I don't know who they are. I have no
Yeah,
no
no,
horse in
understand.
this race. I have
Correct.
no horse in this race, right?
Yeah.
I just want to understand why am we dealing with 1, 2. I don't know. I mean,
Correct. Yeah.
we're dealing 1, 2, 3,
Yeah.
4,
So let me. Yeah.
companies versus dealing with 1 or 2. I mean,
Yeah. So just
and it's
like
a cheaper to do, do we get a discount by dealing with 1 company or 2 instead of 5?
so whenever that we go through the exercise of issuing an RFP, evaluating firms, one of the things like what you are alluding to is whether or not there's actually a benefit to utilize just one firm and then they do it all. We did look at that, but that's not the only criteria that we would evaluate a firm. We would look at their coverage, their expertise, their availability, the other back office support, those type of things, and that's the reason why we came to the conclusion and recommendation that we have.
Yeah, but I'll argue that any one of those companies could do all that. And in the past, we always used to use PFM for the most part, even when they were not the lowest bidder, which I voted against in the past because they were not the lowest bidder. And you could not convince me that they were that great, that they were that different, that justified the higher fee. And now I'm almost arguing the opposite. We went from 1 company to like 5. And it has I mean, I find that hard to understand why. And again,
we're
I
not
don't have
fine.
any horse in this race.
Yeah, no.
I don't know any of the places except the ones that show up to our meetings to tell how great they are,
Understood.
and how great you are when we do a bond sale.
Understood. So in summary, if you look at the sheet, Kinmidder did apply for all. Okay, so they're the only one that applied for all. CFX applied for the first one and the last one. So they only applied for anything to do with financial advisory and bond management. They did not apply for swap. And then for the swap category, we did have other firms that was just interested only in the swap aspect.
Got it.
So,
Got it. Understand it better now.
okay.
Doesn't mean I like it anymore, but I understand it better.
Okay. So these 2 forms, just for the benefit of the group, they do cover close to 2/3 of HFAs across the country. So we are definitely getting good feedback from them in terms of what's happening elsewhere around the country in terms of how to address, bond structure, affordable housing, different products, so on and so forth. So we thought that is a good opportunity for us to tap into that brain trust, so that we can work on our own programs.
And just for clarification, I thought CFX was our cash flow consultant for many, many years. Is that right? Isn't that right?
That's correct. That's correct.
And they're very specialized and have everything modeled up. So,
Correct.
any other questions? Commissioner, do you have another question? No? Well, we have a resolution before us. Any other questions? We have a resolution before us. May I have a motion?
So moved.
Second?
A second, Jerry.
Okay, and I'll call for a roll call vote. All in favor, say aye.
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 Opposed? Abstaining? Passes on a verbal vote. Next into our financial reports, Allison Murphy.
Good morning. Before you are the June financial reports. On the revenue side, mortgage loan and investment interest revenue are coming in 14.3 million over budget for the first half of the year and 25.9 million higher than last year. The increase in the authority's investment portfolio is driving the variances as the portfolio is $905 million higher than what time last year. On the expense side, bond interest expense is 5.9 million above budget through June and 23.2 million higher than last year. Propelling the prior year variance is a $946 million increase in our outstanding bonds compared to last year. Service fees are 2.2 million higher than budgeted for June and are slightly higher than prior year. Administrative expenses are coming in 4 million below budget and 173,000 lower than last year. When you exclude salaries and benefits of 14.8 million, the current year expenses are 205,000 higher than last year. And lastly, the change in that position is above target by 11.8 million. Are there any questions?
Question. So, okay, so our administrative expenses year over year are up, but we're still substantially below budget on administrative expenses. How will that affect? Because I know we're talking about budget later in the meeting, but how is that going to affect our budget? It seems our budget is really. Right, so our administrative expenses are above last year, right? But still way below budget.
A lot of that salaries and benefits. Too.
Right,
A
open
lot of-
positions.
A lot of open
So is it basically the open positions which are running, the vacancies are running year to year?
pretty much. Mhm.
What do we want to fill them?
Mhm. Yes.
It was over 4 million. It's gonna be.
Oh, it's not all just because of, isn't that like also the
It's
capital?
over half of it.
Yeah,
is
over,
salaries
yeah.
and benefits.
Alright, so 2 million, so it's gonna be 5, 6, about.
It's more than that.
It's more than that.
You know, when we budgeted salaries last year for the vacant positions, we anticipated them being on for only 25% of the year. Not like we're going to be higher than one the entire year. So again, that's a shot in the dark, but a lot of us go.
I don't know if others are having a problem, but you're from the vocals from the boardroom are a little muffled for me anyway. Just something to note.
Okay.
And to me too. So no, that I was gonna say something, but since I started this whole thing before, I didn't want it again, especially the person who was giving the report. Either she's too far
Oh.
from the mic or
Allison, I couldn't hear well, and I couldn't
Yeah.
hear Hazim or Jerry.
Yeah.
and
Okay.
normally we don't have this problem.
Yeah, I
And
know.
today I'm actually in my office. So I'm actually, on a line, direct, it's not Wi-Fi. And I'm
Yeah.
using, the latest and the best state equipment.
You missed a great interchange. I'm really sorry. We won't create it, so.
So the problem is from the CHFA boardroom is what I'm trying to say.
There's 2 feeds from the boardroom. Is that normal? Maybe that's what's causing it. I see 2.
No, I think it might be the fact that there might be something wrong with the mic.
Well, I can hear you clearly now, Hazim. so
Yeah.
that's
No,
good.
I'm the closest to the
Okay.
machine here. So just to recap, in case that the committee on the line did not hear the question from Jerry. So he was asking the question about the variance and how it would impact the budget for the following year. So Allison was explaining that it was primarily due to the salaries and benefits or the FTE vacancy. So that's primarily the main driver.
Thank you. If there's no more questions, we'll go on to the production.
and-
Oh,
So Sarah, before you go, I just want to address the questions that Commissioner Perez had from the last meeting.
okay.
So what I did prepare for the benefit of the committee is just a quick summary and to show the difference between what we budgeted versus what was our actual experience. So the first, Lauren, can you just move up a bit? The prior page. You just make sure that you see from the top. So this first box is just trying to show what we issued and what we assume going into the particular calendar year. So I started with 2023. So you can see that when we started when the board approved the budget in November 2022, we assumed for 2023, we were going to issue 725 million of bonds, 675 using tax exempt and 50 million using taxable. And then we ended up only issuing 569 million. And then 24, we then said, well, if it was only 569, let's bump it up from there. We said we're going to issue 650, but we ended up issuing 1.1 billion. And you can see the biggest driver there was the issuance of taxable bonds. Instead of 50 million, we issued over 468 million. And that's because we had to raise additional proceeds to support the homeownership program. And then for 2025, we upped the size of bond issuance from 650 to 966. But through June, we've already sold 771 million, or 80% of what we budgeted for the first 6 months. So Lauren, can you scroll down? So this next category is just the assumption using the yield. So in effect, it's just corresponding, and we were just making some assumptions what we thought we would pay for interest expense, and it correlates to the issuance. So you can see that for 2023, we were pretty close. 2024, because we were issuing more bonds, we in fact went over budget by 20 million. And then 2025, if we annualize for the year, we are essentially 14, 20, yeah, it's basically 12 million over through June of this year. So if you scroll down, so this, Lauren, scroll down. So this is just trying to show, how and the impact of taxable debt to the overall interest expense. So for 2023, we only had 10% of the overall debt taxable, and through June of 2025 is now 14% higher. So go to the next page. So this is, instead of the numbers, this is more like a visual, so you can see the difference. So the green is the tax exempt, and then the orange color is the taxable. And then if you scroll down a bit, so this is just trying to, the PDF is not coming out nicely on the chart here, but in fact, you can see the bars that would show the different colors, and then scroll down. So this would show the interest expense. So this is to just follow up the question that the commissioner had from last month, trying to reflect, how we go about quantifying from budgeted to actual. So Commissioner, I see your hand up.
Yes. First of all, thank you for putting this together. But what this tells me, and I want to acknowledge that budgets are a guesstimate, right? It's like trying to get a crystal ball and predict what the future is, but it's based on historical data, right? Now, having said that, for the most part, we should come close to the numbers that we come up with. Now, there may be things like COVID happens that we cannot plan for, stuff like that, but those are unusual. So what this tells me, at least in the bond issuing, is we consistently have a big variance. If you look at 2023, we budgeted 725, the actual was 569. 24, we budgeted 650, the actual was 1.1 billion. And it looks like in 25, we're going to see that dramatically again. Is there a particular reason why we keep not guesstimating that more closely?
Yeah, yes, I can provide you.
And don't tell me it's because of the market, right? Because we've been around more than a couple of years, so we should be able to take that into account.
Correct.
We may still be
So-
off, but not this kind of margins.
Absolutely. So if you go back, let's say before COVID, we were, year over year we're very close. So when it comes to the 2023, the biggest issue there was the ramp up in the production of homeownership and the slowdown, or I wouldn't say it's even slowed down, the difficulty of multifamily projects getting to the finish line. So in the case of 2023, we were like we were during that period, as you remember, we were exiting COVID. And one of the things that what we were trying to do there was instead of selling bonds, we were looking at opportunities to utilize any cash that we had on hand from principal recoveries, meaning from prepayments, repayments, that we could convert and make loans. If we pull a report from 2023, in fact, we actually produced over 700 million or purchased over 700 million of homeownership loans, but we only issued bonds, like say 500 million. And we purposefully did not want to incur debt because we were sitting on cash. So we were looking at it from an opportunity standpoint to convert cash into investment straight away instead of borrowing money to pay for the purchases. So that was what happened in 2023.
Okay, and that's a great explanation, but my question is, didn't we knew we had excess cash when we did when we put the budget in the first place, or no?
But at the time, no. That was the issue. If you remember what happened between 2022 and 2023, interest rate was changing.
Right.
And then we were dealing with so many things at the time, trying to make sure that we deploy resources the most efficient.
Okay, so what about the next year then, in 24, where we go off so much?
In 2024, when we went in, one of the things that we did not anticipate was the impact of TTO to the whole homeownership program. So instead of doing 700 million of 700 million of production, we did $1 billion. So we were then
So it was a new program. We didn't have historical data.
Correct.
And it was more successful than we could ever expected it. Okay.
So we were playing catch up. So if you look at the number of issuance we did in 2024, we actually issued more issuances than what we did in the past because we were trying to catch up to the production because the pipeline was ever growing. And in 2025, when we did the budget in November 24, same thing like in 24, we were trying to figure out whether or not the state was going to renew and provide additional capital for the TTO program. So we were hedging because we didn't know whether if the state was not willing to recapitalize TTO, then we knew that the size or the production would drop. So we picked the middle. So instead of going all the way in excess of 1 billion, we just assume that production will remain close to 1 billion. So that's why the bond was budgeted at 966 million. And of course, we now know that the state, per the biennium budget, they did approve additional capital for TTO.
Well, I think everybody knew that, I guess, except us, right? Because that was so successful, and no matter which politician, Republican, Democrat, whatever, they all claim that they supported it. But like I said before, it's guesstimate. It's a guesstimate.
Yeah,
At least you have an,
and everybody knows that TTO, while it has been successful, it is also expensive because of the forgivable loan nature. So
right.
we were trying to make sure that,
and that's why it's so popular with the elected officials.
I know,
because the constituents love it.
but from our standpoint, it's like
I don't know. I mean, I just think that those numbers continue every year to have a big gap, and we should be able to narrow that gap at some point.
Yeah, I understood.
Yeah, but I appreciate the numbers. I mean, I like numbers better than charts, but
okay.
I like tables better. I like tables better than I like the tables with the numbers better than the lines and the.
Okay.
But to each his own.
Okay.
All right,
Well,
thank you.
the numbers are there, and so for the other committees online, if you have any additional questions, feel free to reach out to me, and then we can go through it.
Any other questions? Thank you for that. Now on to the production and delinquency report, John Chilson.
Good morning. For the month of June, the authority purchased 307 loans totaling $87.7 million. Reflecting back to the conversation we just had, for the first 6 months of 2025, the authority purchased 1,821 loans, which is 206 loans fewer in the same period of the first 6 months of 2024. However, the dollar value of those loans purchased is the same. It's $505 million. And this is due to the 11% increase year over year in the average loan value to 277,500. 96% of June's production was securitized. That's 294 loans for $83.7 million. And the remaining 13 loans totaling $4.1 million were whole loans. The MBS portfolio as of the end of June was $3.9 billion, which is $66 million over the month-end balance for May. The whole loan portfolio through May declined by 24 loans, or $2.9 million. The single-family delinquency rate was 5.25%, and the year-over-year change in carrying balance of loans in foreclosure increased by $1.9 million to $10.7 million, and there were 17 fewer loans in foreclosure. For the month of June, the authority also funded 57 down payment assistance loans, totaling $624,000, average loan size $11,000, and 188 time to own forgivable loans, $4.4 million, average loan size $23,500. For multifamily portfolio, there were 2 new loan closings and 1 loan status, increasing the number of loans, 3 loans to 614 loans, totaling $1.5 billion. There were 6 permanent loan delinquencies, and the overall delinquency rate for a multifamily portfolio was less than 0.5%. Any questions?
11% increase in the average loan size. It's big.
It
Yeah.
is, yeah.
And that's, I guess, a reflection just of what the first-time home market is requiring.
Right. Yeah, it's 277,500. That's
Is that a record for us? An all-time high, I assume?
Yeah, it's been, yeah. Yeah.
Not surprising.
Yeah, with the average price of a loan in Connecticut.
Yeah.
It's building first of this new supply coming, I assume, so and prices are rising, so probably $100 per foot basis, the prices are higher, everything.
Yeah, and I think that's why the TPO program has such an impact.
Yeah.
It's $25,000 of help.
Right. And that number, that 11% increase in the average loan size, that doesn't include the additional leverage of TTO really effectively, right? So
Right. Yeah.
if you actually put that in, it's even,
Yeah, you're right.
It's like way better.
Yeah.
Look at both.
Yeah.
Any other questions for John? Comments? Let's go on to the investment and swap report, Ning Yang Lee.
Good morning. The investment reports shows an overall increase in book value by $58 million to $5.09 billion, and an increase in program assets by $148 million to $3.85 billion. Quarter over quarter, the weighted yield to maturity for the investment portfolio increased from 4.29% to 4.35%. On the swap report, there is a current hedging position of $920.5 million notional. The authority added a new counterparty and entered into a new swap with JP Morgan in June 2025. With a notional amount of $64 million, the swap hedges a portion of the 2025 C3 variable rate bond. There are currently 42 swaps
with 9 counterparties. Compared with last quarter, the weighted pay rate by the authority fell slightly from 2.898% to 2.887%. Mark-to-market value decreased from 48 million to 46 million. That's all my report. I'll be happy to answer any questions.
Is the mark-to-market in our favor or in the swap provider's favor?
It's in our favor.
Great. Any questions for Ning Yang? Seeing none, let's move on to our last item, which is approval of the minutes of the Finance and Audit Committee of June 6, 2025. May I have a motion?
So moved.
Second?
Second.
Any further discussion? All those in favor say aye.
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 Opposed? Abstaining? It's approved on a verbal vote. And with that, a motion to adjourn. All those in
Oh,
favor?
So Sarah, can I say something before you
Yes.
the committee adjourn? So one of the things that we thought that we should make the committee aware was the opportunity for us to now recycle multifamily prepayments due to the changes made by the federal government to lower the threshold for any tax credit deal from the 50% test to the 25% test. So if the committee remembers, I presented in the past a resolution to establish a credit line to preserve single-family prepayments. But because of the change in law, we then discussed internally along with the credit provider to also open up the opportunity to utilize that same credit line for multifamily prepayments. So in fact, the credit line will help us save the use of new volume cap whenever it's possible for multifamily. So I just want to at least make the committee aware that deals are coming in. We are in fact working on 3 projects right now. 2 of them would be able to utilize the prepayment recycling.
Does that require any change of our approval for the use of that line of credit?
No.
Broad enough?
That was one of the things that we did look at. It's just that when I presented to committee, I did mention that it was mostly for single family because that was the only thing that was available. But when we established the resolution and then entered into the credit agreement with the banks, we referenced prepayments without creating any designation whether it was from single family or multifamily.
Well, thank you for the update. Any questions on that from anyone?
I do. I mean, what would be the impact to our financials? Because that would mean that you're going to have higher interest expense because you're going to have either use the line more often or have a bigger outstanding balance. And I would imagine that we're doing this because it's going to be offset by some revenue or avoidance of some other expenditure.
Correct. Good question. So for multifamily, the code essentially does not allow us to hold the prepayment for too long. Effectively, we have to convert the prepayment within 6 months of such prepayment. So the plan is, if we are going to use the line, is mainly to tackle or basically incur debt for about a week. So we would take over and prepay the old bonds, incur the debt using the line, but then the bond issuance will be done the week after. So effectively, if any, it will be for that 1 week of interest expense on the line.
Okay, but again, what's the bottom line impact? Is that a negative? Is that neutral? Is that positive?
Right now is minimal because unlike single family where you have a portfolio of loans and people prepay literally on a daily basis, multifamily is a bit more unique because it only can be-
Prepayment don't happen as often.
it's not happening as often and is only coming from construction loans. So if it's a prepayment from a permanent loan, it does not apply. So the universe is very small.
Okay. Thank you.
Sure.
Any other matters or discussion? Seeing none, motion to adjourn. All in favor, say aye.
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 Thank you. We'll see you at the
Thank
board
you.
meeting.